Hey everyone, and welcome to the second episode of the interview series. And today we have with us Marc Lichtenfeld, who is the Chief Income Strategist for the Oxford Club, and he is the author of the book Get Rich with Dividends, a Proven System for Double-Digit Returns. All right, well, thank you for joining us today, Marc. So would you like to just give a brief introduction of yourself to the audience?
Sure. So as you mentioned, my name is Marc Lichtenfeld. I'm the Chief Income Strategist of the Oxford Club. And my primary role at the Oxford Club, I write the Oxford Income Letter, which is a newsletter focused on dividend investments and uses the same methodology, which is called the 10, 11, 12 system that I wrote about in my book. Just kind of created this system and then started applying it in the newsletter.
Oh, nice. And so for yourself, how did you get started with investing, or how did you get started with finance, or how did you even get started with the Oxford Club?
So I did not have a very traditional career path. When I was a kid, so my grandfather actually had a seat on the New York Stock Exchange. So he and his brother, my great uncle, had a brokerage company, and that were very involved. And I would talk to my grandfather about it. Actually, when I went to college, I had absolutely no interest in the market. I wanted to be a sportscaster, and so I was a communications major. And when I got out of school, I started getting my first paycheck and much, but somehow there was a little bit left over at the end. And so I decided, I got to figure out a way to make this money grow. And so I just became consumed with the stock market. I started reading everything I can get my hands on, and this was in the days before the internet. So I would actually spend weekends in the library, reading things like Value Line and just kind of learning, basically from scratch. And then after a number of years, I finally decided to make that I was spending all my free time my career. So I started applying for jobs. At the time I was living in Frisco and was applying for jobs all over the city. And of course, nobody would hire me because I didn't have any experience. So there was a trading firm that was a 5-minute walk from my house, and I saw an ad in the newspaper. Again, this was a long time ago. They needed a trading assistant. So I went in, gave my resume, and the guy kind of looked at it and said, all right, we'll get back to you. Knowing that they're not going to get back to me because, again, I had absolutely no experience. So I did see that they just really needed somebody right away. And this was like on a Monday or Tuesday. So I said to him, I'll tell you what, I'll work the rest of the week for free executing these trades. If on Friday you don't think I did a good job, then just tell me not to come back on Monday. And so I did it. And on Friday he said, okay, come back on Monday. So that was the start to my career. And then I hooked up with the Oxford Club almost 10 years ago now. It'll be 10 years in June. And it's just been a fantastic experience. They're just a great company. We have just brilliant editors who I love working with and bouncing ideas off each other. And we all kind of specialize in different areas. So it's helpful for me to call up one of the other editors, and if I'm kind of thinking about some aspect of the market. We never say, hey, what do you think of XYZ stock, but more on a macro level. We'll kind of bounce ideas off each other. And I became the Chief Income Strategist, I think it was 4 years ago, I think it was, when I launched the Oxford Income Letter. So wow. That's the short version of my career.
That's amazing. You're hustling, just saying, hey, I'll work for you for free, and if you like it, that's you can keep me on, and that's amazing. I like that drive of yours, so that's great.
I mean, I figured well, first of all, it was a very small firm, so you couldn't do that at JP Morgan. Like I said, I figured I had no choice because nobody was going to give me a shot with zero experience on my resume, so I kind of had to kick open the door when it was when it was open just a crack. So
yeah, no, I love it. So you mentioned earlier that you came up with the 10, 11, 12 strategy. For the audience who doesn't know what that is, could you elaborate more? And the second part of that is, how did you come up with that idea?
Sure. So the 10, 11, 12 system, the idea behind it is that it's a long-term investment strategy of dividend growth. So the idea is that in 10 years, if you are collecting the income today, if you need the dividends today for income, in 10 years, you'll have an average 11% yield. If you're building wealth by reinvesting the dividends and letting those dividends compound, then the idea is that in 10 years, you will average a 12% total return. And 12% doesn't sound like a lot, but it triples your money over 10 years, which is significant, especially if that's a one-time investment and you never touch it. So that's the goal, and there are certain parameters that you have to try to hit as far as starting yields, dividend growth, and things like that. And it's also based on the assumption that the market will go up by the historically average amount. Mm-hmm. So for the S&P 500 is about 7.65%. So we're not trying to pick stocks that are going to be the next Apple or the next Tesla or Facebook. We're not trying to shoot the lights out. We're just trying to find companies that'll just perform in line with the market as far as price appreciation, but it's that dividend growth that is going to get us to significant outperformance, to that 12% average total return.
Okay.
And then the way I came up with it's basically I was trying to come up with a system, because people love systems, and I wanted something that people could implement very easily and understand easily, because so many people, when it comes to investing, they try to do too much. They overtrade, they overinvest, they try to get in and out of the market. They read a headline and they think the world's coming to an end, or that this is the next great time to invest. So I was trying to come up with something that was just really simple, that would kind of do away with all that. That would almost be set it and forget it. I don't think you can ever truly forget it, but the idea with this is you don't have to check it very often, and you probably don't want to. More than once a quarter, I don't recommend, and you could probably even get away with doing it once a year. So that was really kind of the inspiration behind it, to just come up with something that works over the long term, and that people don't have to do too much, because not everybody is passionate about the market like I am. Some people just want to buy a few stocks, and then in 10, 15 years wake up and have a lot more money than they did when they first started.
Yeah, no, it's great. I agree with you completely. And so for yourself, would you say the 10, 11, 12 strategy is more of active investing or passive investing, or kind of a blend of both? Because you are looking for stocks to pick. Right.
So, I mean, when you're starting it has to be active, because you're picking the stocks. But after that, it can be passive. Like I said, it's not going to be set it and forget it, because you don't want to ever just buy something and not look at it for 10 years. Although actually there's been all kinds of studies that show that is the best way to invest. There's a Fidelity study where they looked at the best performing accounts that they, the hundreds of thousands of accounts or millions of accounts that they have, and the best performing ones were ones that people forgot that they owned, or the person had died and nobody claimed it. So it literally had nobody had touched it. That being said, that's not something I recommend, but I do recommend that like I say, you don't want to overtrade it. You don't want to constantly be looking at the headlines of your stocks, worrying about if they missed earnings by a penny. None of that stuff matters when you're talking about a great company that's raising their dividend every single year, that you plan on owning for 10 years. You want to make sure that company is raising the dividend, that they can afford that dividend, that there's not some major issue that's really going to mess up their fundamentals and their ability to pay that dividend. But other than that, you really don't want to play around with it too much. As long as kind of those major things, that their cash flow is growing, they can pay that dividend, and they're continuing to raise it, for the most part, you don't want to touch it.
Okay, and it's a great point. For yourself, what would be an example that follows that 10, 11, 12 rule? Which company would be something that you would think that follows that 10, 11-12 principle?
So, very generally speaking, in the book, I talked about you generally wanted about a 4.7% starting yield and 10% dividend growth per year that you expect. Those numbers have been able to come down a little bit because, remember, I mentioned that we're also assuming that the market is going to go up by the historical average, and it's been a very strong bull market over the last 9 years now. So that historical average has come up a little bit. So we can bring down the numbers a little bit. So, for example, if you can find a 4% starting yield with 10% average dividend growth, generally speaking, that should get you to where you want to go as far as the 10, 11, 12 system. So just an example of a company that I really that I've done very well with in the past is Darden. Now, when I first recommended them, this was a few years ago, they had a dividend yield close to 5%. Their dividend had been growing. The company was actually having trouble at that point. This is when Olive Garden was really struggling. It was almost, Olive Garden was kind of the butt of a lot of jokes. I mean, the company was not doing well by stock market standards. But if you dug into the financials a little bit, they still generated tons of cash flow, even though people weren't showing up to Olive Garden the way they used to. But the cash flow was there, and they could more than afford that dividend that they were paying. So what I often find, especially in this market now, because we are, like I said, 9 years into a bull market, is to get those higher yields, you generally have to find companies that are a bit contrarian, that are, they have a little bit of hair on them. There's a reason why a company today might have a 4.5% yield when your average, quality company, a blue chip, might be paying 2.5%, 3%. So, really kind of going for companies that are a little bit down and out, but are generating that cash flow. So actually, an example today is Gap. GPS is the symbol. And again, it's a retailer kind of like Darden was, where people kind of laugh at you if you bring that up as a place that you're either shopping or a stock that you're interested in. Everybody will think you're crazy. In Darden's case, they threw out the CEO. An activist investor came in. They spun off their real estate, and the stock's done fantastically well. So I would like to see the same thing happen with Gap. The numbers, the starting yield, the previous dividend growth, and what I think the projected dividend growth could be significant as soon as they kind of get back, get their mojo back a little bit. But they've got a fantastic yield, and the key thing is they can afford that dividend. A lot of times you'll find a company that's a little bit down and out, and they can't afford the dividend that they're paying. They're paying out, just as an example, they're paying out $100 million in dividends, but they're only generating $75 million in cash. So that's not a situation. $1 million in cash flow, $100 million in dividend. And even while traffic is down, what have you, is that I'm really excited about, and it becomes to stick with. I don't want to stick with it for 10 years. Companies, I'll give it 2 years. Even was there.
Okay. No, it sounds yeah. For yourself, do you look at?
I don't know if you can hear me, but you're.
Hello. Do you? Are you able to hear me? Mark.
Yeah, you're freezing up.
Okay. Okay, there we go. We're back. It's much better now. So, for yourself, do you look for specifically just American companies, or do you? Yeah, I can hear you well. Do you look for specifically just American companies, or do you look for companies outside of America as well? Hello? Who? Mark?
Can you hear me now?
Yeah.
Yeah, we're having some technical difficulties here.
Yeah.
So I did hear your question. So in the Oxford Income Letter, I only recommend companies that are traded in the United States, but they can be foreign companies traded in the United States. So, for example, one of the current recommendations is BCE, the Canadian telecom company. You also have NTT Docomo, the Japanese mobile telephone company. So I will recommend those companies. That makes the job a little bit more difficult because when you're looking at that dividend growth, you do have currency fluctuations. So even though the company might be raising the dividend in their local currency, as an American investor in the United States, you might not be getting the benefit of that raise if the currency markets go against you. That being said, I don't worry about that too much because, again, with a long-term strategy over 10 years, I assume all those currency fluctuations are going to work themselves out over the long run. And as long as the company is raising that dividend every year, we should do pretty well. So that doesn't bother me. I don't recommend companies on other exchanges just because for my readers, most of them are in the United States or trade in the United States, and it would just be too difficult for me to be able to recommend a company in France or Germany or what have you, or somewhere in Asia.
Okay. Yeah, no, it's a great idea. For yourself, do you allocate the assets, or do you allocate your portfolio? So, example, you'll have a certain amount in this industry or this industry or this country. So how do you allocate your assets or your portfolio?
So I don't necessarily say, well, I'm going to have 20% in telecom and 25% in tech and 10% in healthcare. It's a little more kind of by feel, I guess. I'll try not to get overweight in a certain sector. Like I said, I had BCE and NTT Docomo. I also have AT&T in the portfolio. So I'm not really looking for another telecom at this point. But and depending on what's happening in the world and the economy, for example, right now I am interested in financials as interest rates appear to be heading higher. That's something I'm going to want a little bit more exposure to. So I just kind of feel my way around. When oil absolutely tanked and oil was trading at $30 a barrel, that's when I was adding oil companies because I didn't have very many at that point. So it's a little bit more of that rather than kind of a hard and fast rule.
Okay.
And same thing with international versus U.S. So I'm not saying 10% in Asia and 20% in Europe and the rest in the U.S. It's kind of looking at the portfolio and saying, okay, it's. I think we should be looking for something in another part of the world at this point, or I'm going to back off and stick with an American company for the next few months.
Oh, okay, that's great. And for yourself, what are your thoughts on index investing? I know there's a lot of gurus who talk about, especially Warren Buffett and John Bogle, starter of Vanguard, who talk about just putting your money in low-cost index funds. What are your thoughts on that?
So generally speaking, I am in favor of that. I actually do some of that myself. For my long-term money, I have a good chunk of it in these Vanguard index funds and a good chunk of it in dividend growth companies. What's nice about the index funds is they're dirt cheap, and those really are kind of set it and forget it. You don't have to look and see what the headlines are and all that like we were talking about before. But what I prefer about the dividend growth companies, with the index funds, you're never going to outperform the market. You're just going to do whatever the market does. So with dividend growth investing and the way I do it with the 10, 11, 12 system, you should outperform the market because you're investing in these companies that are raising their dividend every year. And the other thing, too, is that these companies tend to be a bit safer. So when the market is white hot, yes, you might underperform the market. But when the market struggles or is down, then you should actually outperform the market. And so by investing in these companies, you should outperform the market, and that's, average is fine, but I'm looking for better than average. So and 12% average total returns over the long term is much better than average.
For sure. It's it's so you're saying that just putting your money into index funds is just a very kind of safe way to preserve that money or to preserve and grow.
Yeah, I mean, and I mean, it is safe, as far as the whole market is concerned. I mean, understand the stock market does have risk, and you can hit a bear market. Sure. Nothing's guaranteed. But as far as strategies go, it's certainly one of the better ones, and one of the main reasons is because it's a long-term strategy. If you're not over trading it, like we were talking about earlier, that's usually the way to go, and it's cheaper. So if I'm investing in an index fund and the expenses are 0.2%, and you're investing in an actively managed fund that's 1.5% expense, even if they perform the same, I'm going to make more money because I'm paying a lot less for it.
Yeah.
So and I'm sure you've heard the statistics. Most mutual fund managers don't outperform the market; they actually underperform. But even if all things are equal, if you're just paying less for the same performance, then you're going to do better. And what I like about the dividend growth investing, though, is that's also very, very cheap. So yes, it costs you a commission to buy a stock, but these days, if you're doing it online, here in the United States, it costs $7 at a lot of the discount brokers, and then you never have to do you never have to do anything again. So if you bought 10, let's say you had a $10,000 portfolio and bought 10 stocks, it would cost you let's say $70, and theoretically, it wouldn't cost you anything after that for years, and you can reinvest the dividends usually for free. Most brokers let you do that. So you could just have this kind of one-time expense, let's say, and then never have another expense if you never traded the stock again, if you just held it for years and years. So it's also a very cheap way of investing in the market.
Okay. And do you dollar cost average, or do you lump sum purchase the shares all at once?
For the newsletter, it's all at once because it's just kind of the mechanics of the newsletter business. It would be too difficult for me to say, okay, do 10% now, and we're going to do another 20% in 3 months. So when I recommend a stock in the newsletter, it's just buy the stock now. Okay. When I'm investing for myself, I'll buy an initial position, and it will be the position, generally speaking, the full position that I expect. But as time goes on, as I end up with more capital to deploy, then yes, I will put more money into certain positions, especially if they've gone down. And I still like the company, and they're still paying the dividend, then and raising that dividend, then yeah, I'll absolutely put more money in at a lower price.
Okay, and no, that sounds good. And so for yourself, who are some investors or some of the investors that you follow or that have inspired you?
Well, the one that probably inspired me the most is David Dreman, Dreman. He wrote, blank on the name of the book now, I think it's called Contrarian Investing. Okay. It's a thick, dry book about investing, but he's really the father of contrarian investing. And that's basically when you're buying these stocks that everybody else hates, kind of like I was talking about Dart and Gap today. And you have to have a reason to expect that the companies are going to improve. You don't just buy stuff everybody hates, because there may be a very valid reason why people hate it. But it really kind of helped kind of shape my attitude and just my thought process on why the crowds tend to move in a certain direction, and kind of what to look for as far as thinking why they might be wrong. You don't just bet against the crowd just because the crowd is moving a certain direction. You really want to do it at certain extremes, and so it really just fueled my. It was one of those things that really kind of fueled my passion for the markets too, because I saw this as a way to do something that not everybody else was doing. Everybody likes to call themselves a contrarian, but it's very, very difficult to be one. I mean, it's not too many people were putting money to work in 2008 and 2009, and when a stock is crashing, it's hard to buy it. So that book to me is definitely my favorite investing book, hands down. And of course, Jack Bogle, Warren Buffett. I mean, all the typical names, and you can learn from everybody, even bad investors. I mean, you see what they did. I mean, I learned more from the trades that don't work out than the ones that do. Because I was going back and saying, okay, what was my thought process here? What did I miss? How did I, was there something different I could have done? Was my analysis wrong, or did the market just not cooperate? So, basically, kind of when I was talking about my origins in the market, was just reading everything I can get my hands on, and I still do that today.
That's good. No, it's. I think it was Abraham Lincoln who said, "I learn from everyone, but from most people, I learn what not to do."
Oh, yeah. I mean, there's an expression. Sometimes the best trade is the one you don't make.
Yeah.
And there have been many, many times where I've been very close to pulling the trigger on a trade and held back for whatever reason, and then something happens and the stock blows up, and thank God that trade. So
yeah, okay, well, no, that sounds good. And I guess for someone who's just starting out in investing, what would your advice be to that person?
So like I said, read everything you can get your hand on, and these days, there's so much on the internet, and some great books. There's the best book, or the first book that I read that really, really helped me. If you're brand new to the market, it's called Understanding Wall Street by Jeffrey Little. It's been around for decades, and it just really explains, this is what a stock is, this is what a bond is, this is how the market works. So it's really for people who are brand new, but it's fantastic. Reading, I still read Barron's cover to cover. Read the Wall Street Journal, read Investors Business Daily. If you find a company, like ours, like the Oxford Club, or somebody else that that you connect with that makes sense to you, there's a lot of free stuff. We have our free website is wealthyretirement.com. So read as much as you can. And actually the brokers have a lot of good information too. The Vanguards, the Fidelities, the Schwabs, the Ameritrades. They have a ton of free information. They really do a good job these days of trying to help the novice investor, giving you as much information as you want. Their sites are loaded with data on stocks and things like that. So it's really a matter of getting in there and not being afraid. It can be very intimidating when you're first starting. Take it slow. You don't have to put all your money to work at once. Buy some index funds at first. Buy a couple of dividend growth stocks. Some conservative things. And again, be invested for the long term, and you should be fine. And the reason I'm so focused on the long term is because stocks do go up over the long term. In my book, I took a look at rolling 10-year periods, and there were only 7 periods of 10 years where the market did not go up. And they were all affiliated either with the Great Depression or Great Recession. So meaning if you sold in 1936, if you sold in 2008, 2009, you didn't make money. Any other time you did. So even if you bought like in 2001 in the middle of the dot-com crash and sold in 2010 having experienced the Great Recession, you still made money. Not a ton, but you made money. So that's an important thing for new investors to understand. If you're investing for the long term, you'd have to have historically bad timing to not make money. You'd have to buy, right as things were about to fall off a cliff, and then sell, after they've fallen off a cliff, right into the bottoms. Otherwise, at least historically, over 10-year periods, the market does go up. And over 20-year periods, if you have that long, they've never gone down. So I think it's really important for novice investors to understand, because it's a scary world out there. There's always scary headlines, and there's a lot of people, a lot of bearish people out there who are always telling you that the market's going to crash, and sometimes they're right, but over long periods of time they're not. And generally speaking, like I said, unless you have this historically bad timing, you make money over the long term. So I think that's important for new investors to understand and give them a little bit of sense of security that even if they make some mistakes early on, they'll probably be okay over the long term.
That's great. Well, thank you for sharing that. And so for yourself, why did you decide to write your book?
Basically, it was kind of the book I wish I had read in my 20s. I got very lucky and actually read a statistic early in my 20s that had to do with compounding, where at the time, back then, the maximum you could contribute to an IRA was $2,000. And it said if you started contributing $2,000 a year at age 21 and stopped at 31, you would have more money at 65 than if you started at 31 and invested every year up until 65. And so that made a big impact on me. So I started investing, but I didn't know how. I was just putting it into mutual funds and not even index funds. I was, into, I think, some Fidelity funds that had active managers, and I did okay, but not as well as I could have. And so this was kind of the book written to my 22-year-old former self of everything I wish I had known. And really also kind of wrote it for my kids who are teenagers, and for anybody else who is either just starting out, or you could be 65, 70 years old and looking for a way to grow your income every year. But it's not, I didn't invent dividend growth investing. I just kind of packaged it and created the system to make it very simple to do it. And it's just so powerful, and it works. That was the thing. When I ran the numbers over, going back to the 1920s, and this really works. And so, and it's simple. So it's especially after the Great Recession, and so many people got hurt so badly. I wanted to show people a very easy, safe way to make money over the long term, where they wouldn't have to, they wouldn't have to watch CNBC or check their stock quote every 10 minutes.
Yeah, no, that's true. It's definitely make your mess your message, right? So definitely take whatever sort of feelings that you had and try to help others. Yeah, so that's a really good way or a great motivator. And writing, in terms of writing the book, what was the process like?
It was awful. I equated to giving birth, and I swore I would never do it again, and now I find myself in the middle of writing another one.
Uh-oh, I'm excited.
So, it was a very difficult process for me. This was, the first book I'd ever written, and I do write for a living, but I write in, 1,000, 1,200 word increments, on very tight deadlines. And here, I forgot how many words the contract was for the book, but whatever it was, I kind of, my process was probably not the right one. What I did was I wrote a first draft and just kind of wrote everything that I thought I knew about the markets, and it turned out that was very, very little, because I was nowhere close to satisfying my contract. So then what I do is I kind of went back and said, okay, where can I add more detail? Where can I add a lot more research, more data? Because I had these ideas, and I knew based on the research I had already done, I knew that the system would work, and historically, had back tested it and that would have worked throughout history, or at least the last 90 something years. But there was a lot more data to kind of be farmed and to support what I was saying. So there was a lot of that. I also did some interviews. I talked to some CFOs and CEOs about why they raise dividends, why they pay dividends, things like that. So it was a lot of research kind of after I did that initial, I think it came out to like 75 pages, at first, just like I said, put everything out there, and then, okay, how do I make this readable and support my thesis, and so that was a process. It's probably the wrong way of going about it, but and then there's a lot of procrastination too.
Well, at least now you know for your second book, right? So, how long did it take you to write this book?
It took about 6 months. It should be about a year, but I wanted to have it published for a conference. I wanted it to be out for a conference that the Oxford Club was doing, and then there's several other conferences that were coming up immediately. So if I had taken the full year, I would have missed those conferences, and then would have had to wait another 6 months. So the book would have been a little bit, I wouldn't say stale, but it wouldn't be news by that point, those conferences. So I really pushed the publisher, and they kind of thought I was a little nuts to do it in 6 months, because it generally takes about a year to do a book. Actually, the book I'm working on now has taken more than a year. So I kind of crammed. At one point, I sent my family away for the weekend so I could have 48 hours with no distractions to really make some progress. So I really kind of crammed a lot of work into a short period of time. I wouldn't recommend doing that again.
No, that's I can imagine just sitting down and just waiting for the creative juices to come, and if it's not coming, you're just trying to write down and just get out your thoughts, and I can imagine doing that. Must be tough.
And it was tough. Luckily, it was a passion project too, though. So, when you're excited about something and you feel strongly about it, it was a lot of work. I'm not going to say it wasn't. I know it was tough, but I was so into it and so into the research and finding all this data and everything I was doing. So that part certainly made it easier.
Yeah, for sure. Being able to see your final product. And for any aspiring authors or writers, what are some tips that you'd give to them?
That's a great question. Well, definitely, write about something you're passionate about. Otherwise, it's just going to be too difficult. If you've been assigned to write something and you're not in love with the subject, it's going to be a slog, because even when you love it, it's hard work. There's a I forgot who had written about this, but basically the idea that you just write every day. Write a certain number of words every day, even if you have nothing to say. I didn't quite do that, but I did try to sit down as often as I could and just hammer something out. And half the time it was garbage and I had to delete it. Half the time, 90% of it was garbage, but there was one paragraph or one sentence that I said, oh, there's something here. I'll go back to that next week. So the hardest part, at least for me, is the procrastination, and the act of sitting down and getting it done and starting is the hardest part for me. Even now, I'll always, I'm like a dog, like, ooh, something shiny, or squirting. I'll distract it too easily. But once I sit down and start, then I make a lot of progress. So, don't do what I do. Try not to get distracted. Find a quiet place, sit down as often as you can, and just start writing. And if you're into it, good things will start coming. And then also, the other thing too is have somebody who's not necessarily an expert in your field read it. So I had my wife go through it, and she knows investing from me talking about it, and she was a finance major. So she knows something about it, but she hasn't really worked in finance in a very long time. So for her to read it, she could say, well, this doesn't make sense to me. This isn't, and even though it was blatantly obvious to me, because I've been in this business for almost 20 years, for her and somebody like that is my target, somebody who isn't an expert. That really helped, because then I could go say, okay, well, if she's not getting it, other people won't get it, and so let me tweak this. And so having somebody who can give you honest criticism, who's not an expert in what you're writing about, is very valuable.
Okay, no, that's really good. That's a really great tip. And knowing what you know now, if you could go back in time and tell yourself 3 things to your 20-year-old self, what would those 3 things be?
Start investing as much as you can afford as early as you can, and invest for the long term. So don't overtrade. Just find either some great index funds or great dividend growth companies, and just let them ride for as long as you can. And like I was saying, and read everything you can if you're interested in investing, which I was. Read everything because there's so much good information out there. But really, the main things, though, invest as much as you can as early as you can, because the compounding machine is amazing. And when I was writing the book, I built an Excel spreadsheet to figure out kind of how the numbers were going to look. And the hard part is when you're first starting investing, that compounding isn't that exciting at the beginning. It takes a while to get it going. And so those first 5, 7, 8 years, there's not a lot happening. But once you start getting past 8 years, 10 years, the numbers start adding up pretty quickly. And when you see this in a spreadsheet, it's amazing, just the difference between 10 and 15 years and 15 and 20 years. And so just being invested for 3 or 5 extra years can really make a very profound difference in your wealth down the line. And when you're 20, you're not really thinking about being 50 or 60, but it does happen. And so believe me, at 50, you'll be so glad that you invested when you were younger. But again, that doesn't even have to be for somebody who's 20. If you're 50 and haven't started, you do it now, you can be in great shape when you're 70. So, it's not only for young people.
Okay. No, that's great advice to yourself. And we're just wrapping up the interview. And so where can people find you, or where can people connect with you if they're interested in learning more about you?
Sure. So we have a free website, wealthyretirement.com. And my paid newsletter, the Oxford Income Letter, is at oxfordclub.com. And I'm on Twitter at Stocks and Boxing. So Stocks and letter N, Boxing. I have a weird side job as a ring announcer on nights and weekends. So I'm mostly tweeting about stocks, but occasionally something about boxing. And then I'm on Facebook, facebook.com/OxfordMarc, MARC.
Okay. All right.
And
well,
that book is on Amazon.com.
Okay. Yeah, I'll post all the links down below. So for the audience members, the links are all down below for you to connect with Marc. All right. Well, thank you very much, Marc. That was that was great. And thank you again.
Yeah, my pleasure. Thanks for having me, Ryan.
Yeah.